Hello, this is Robert Kavcic, Senior Economist with BMO Capital Markets. There's a big debate raging right now over Canadian housing valuations, and a lot of attention has recently been focused on the cost of ownership versus renting. The OECD, for example, like the Economist magazine, continues to spur bubble talk with claims that Canadian home prices are extremely overvalued versus rent. So we asked two questions. Are Canadian home prices really that overvalued versus rent? And should someone in today's market buy or rent? Now, at the center of the debate is this claim that prices are 64% overvalued versus rent. This chart shows the method used by the OECD, which basically looks at the movement of the price-to-rent ratio over time and compares it to the long-run average. Now, intuitively, the fact that the late 80s bubble in Toronto, which we know is a classic speculative bubble, shows up as only slightly overvalued under this method is pretty suspicious right off the bat. More importantly, the latest upward drift in valuations comes in a period of falling interest rates, and interest rates, of course, are the key factor in the valuation in any stream of future cash flow. So from an investor's perspective, that would be rental income, or from the homeowner's perspective, that would be saved rental costs. So because lower interest rates increase the value of future rents in today's dollars, all else equal, they should also lift the current home value and the price-to-rent ratio, and that's just exactly what we've seen. As an alternative, we look at the ratio of rent to the mortgage payment on an average price Canadian home. On a national basis, ownership currently looks only moderately expensive versus rent, or barely at all if we use current market mortgage rates rather than posted rates. Of course, if mortgage rates were to rise to 5% overnight, then yes, valuations would become legitimately lofty. Notably though, valuations are now comfortably below levels that we saw in the late 80s and the mid-2000s, and both of those were precursors to significant housing market corrections in Canada. There are regional differences as well. Vancouver valuations are currently compressing from very high levels, but they are still elevated. Calgary's market also looks pricey, but well below levels seen at the height of the energy boom in the mid-2000s, and resurgent rent growth now in that city is actually at least partly offsetting recent price gains. Toronto actually appears more fairly valued and is still miles away from bubble conditions that we saw in the late 1980s. So rent or buy? To answer that question, we zoom in on the GTA and we look at two different cases. Case one involves buying a condo in the GTA with a 5-year time horizon, like a young professional moving to the core for work for a few years, for example. At a $300,000 price and a rent of $1,500 per month, it would take annualized price growth just shy of 2%, or an 11% total increase for a buyer to break even versus renting that same unit. The other key assumptions are laid out on this slide, and more details are in the full report. The first takeaway here is that even in the often attacked Toronto condo sector, the market is not factoring in irrational price growth at all. But that said, we still judge that the risk of buying a condo for a 5-year period does outweigh the potential reward just given current market conditions. There are a raft of completions potentially hitting the resale market in the coming years in Toronto, and condos will struggle to churn out much price growth in the near term. And if prices do flatline, renting would yield an equity gain of about $28,000, or almost 30% in this case. And that balloons to almost $60,000 in the event of a 10% correction. So all told, renting a condo does in fact look like a wise choice in Toronto for the next 5 years. Now the second case is a detached buyer with a much longer 15-year time horizon, like a young family moving to the suburbs, for example. In this case, it would take annualized price growth of 2.5% for the buyer to break even versus a renter in the same house. If prices slightly trail income growth at about 3% per year, which we think is very reasonable in a much tighter detached market, then owning yields a gain of $70,000 or more than 10% versus renting. Then there are the practical considerations too. Realistically, you probably don't want to be moving a family every few years, and we ignore those costs in the simulation as well. And even simply finding detached properties in preferred neighborhoods of the GTA is no easy task. There's also the likelihood of not actually selling after 15 years, and this is important because closing costs are significant in this simulation, and of course mortgage payments stop after 25 years where rent continues indefinitely. So as the time horizon stretches out, the case for ownership actually becomes much, much stronger. So all told, we don't expect wealth creation from home ownership is going to be anything like that seen over the past decade, but that said, buying a detached home for the long run still looks like a better choice than renting. The full, more detailed report is available on our website, and you can contact me using the information on the screen if you have any more questions. Thank you.